This Genscape educational webinar. My name is David Franker. I am the Chief Marketing Officer here at Genscape. Today's topic is AB 32 and the impact on Western power markets. But first, a note about our company. Genscape is unique in its ability to measure market fundamentals using thousands of patented energy monitors strategically deployed all around the world. These measured actuals are transmitted in real time or near real time, often delivering a first mover advantage to our clients. We provide this proprietary intelligence across the commodity spectrum in power, oil, natural gas, and agriculture, with operations across North America and Europe. As part of DMGT's $2.2 billion portfolio of market-leading companies, Genscape thrives on increasing transparency across global energy markets. With that, we are here to kick off the AB 32 Market Impact on Western Power Markets webinar. If you have any questions at any time, please don't hesitate to submit them via the webinar chat window, and we will answer them at the end of the presentation. Now I'd like to turn it over to Chris Jilka, the Director of West Power Markets. Chris?
Great, thanks, David. My name is Chris Jilka. I'm the Director of the West Power Desk, and with me is Peter Richardson, my colleague, who is the Senior Analyst on our team. Together we're going to give you a brief tutorial on AB 32 and some of what we've observed in the last couple of months as we prepare our models for the January 2013 contract. If you do have any questions during the webinar, you can submit them to the chat window at the bottom of the control panel. So on the agenda for today, we'll do a brief intro to Genscape. What is AB 32? And then Peter's going to go into some impacts, possible impacts on carbon to the Western power markets. So about Genscape, as Dave said, we're a global provider of fundamental data in power, natural gas, oil, agriculture, and now shipping. For electricity analysts, we have four main product offerings, and those include Power RT, Transmission RT, Windcast IQ, and Power IQ. And today we're going to talk about Power IQ. Although my team here in Boston, we use all four of these offerings in our analysis of the power markets. Power IQ covers all the major ISO and RTOs, and we're going to focus on CAISO and WECC. Our CAISO offering is Bal Day Next Day. Our WECC offering is Bal Month Next Month, which provides a 60-day forecast. The foundation of our service is really to help traders and asset owners maximize profit and risk through detailed fundamental analysis. Our analysis includes base case price forecasts, demand forecasts, sensitivities. We can also run ad hoc model runs. We provide daily recaps on all the fundamental data and what occurred the prior day, and then all of the output from all the models is available via an XML data feed, so you can feed that into your own internal systems or models. So what is AB 32? AB stands for Assembly Bill 32. It's also called the Global Warming Solutions Act of 2006. And what it does is set 2020 greenhouse gas emissions, otherwise known as GHG, reductions into law. By 2020, the state must return to 1990 GHG levels. And this should deliver an approximate 15% reduction compared to a business as usual approach or doing nothing. So the primary facets of AB 32 are low carbon fuel standard, mandatory recycling, renewable electricity standard, compliance offset protocols, clean car standard, and finally cap and trade. And today we're going to talk about the last, cap and trade. So cap and trade basically sets a yearly maximum cap on GHG that declines over time. And that starts January 1st, 2013. It declines 2% annually to 2014, and then declines 3% annually to 2015. And it covers all major sources of emissions, utilities and large industrials. And if you look at the graphic in the upper right part of your screen, you can see that the 2013 inclusion does include imports, And California supply, it basically imports about 1/3 of their supply from adjacent control areas. So imports are a big part of AB 32. The California Air Resources Board, or CARB, initially distributes available permits. Each covered entity is required to submit 1 permit for every metric ton of CO2 equivalent they emit. What you submit is determined by the quantity of reported and verified GHG emissions from past years. Reporting began in 2008. So obtaining permits. CARB gives free permits to entities that equal about 90% of their historic average GHG emissions. It's important to note that this will change to 50% by 2020. The first auction actually occurred a couple weeks ago, November 14th, and the 2013 vintage cleared at $10.09 per metric ton, which is near the price floor. And this is important to note because for the very first time it provides price discovery on CO2 in the Western markets, and it is a true milestone. Every subsequent year, they'll have 4 auctions that occur in the second month of every quarter. Offset credits are at most 8% of the entity's compliance obligation, and they must be a North American project. Forestry, urban forestry, dairy digesters, or destruction of ozone-depleting substances like refrigerants are included. Offsets must be independently verified, and a framework does exist for future inclusion of an international offset program. Surrendering permits. There are 2 surrender deadlines, annual and triennial. The annual obligation is 30% of the reported emissions in the previous year. Triennial is based on predefined compliance periods. The obligation is a sum of reported emissions during the compliance period minus what is surrendered as part of the annual compliance period. If the deadline is missed or there's a shortfall, there's a penalty of 4 allowance per metric ton applied. And this is up from 1 allowance per ton in the initial obligation, which is a 400% increase. 4% of allowances are held in strategic reserve, and holding limits are established so there's no cornering of the market. So some recent actions or news items. Resource shuffling is any plan, scheme, or artifice to receive credit based on GHG reductions that never occurred. And this applies to imports, which, as I said previously, can be 1/3 of the California electricity supply. There is an attestation required for first deliverers. And basically what an attestation is a statement submitted annually that says that that agent has not shuffled resources and it subjects them to CARB enforcement mechanisms. First deliverers are the last entity in the physical path segment that crosses the California boundary. FERC was not happy with this definition and has directed staff to work with the California ISO, the Public Utility Commission, and the CPC to redefine it by mid-2013. And the main takeaway from this slide is per FERC, resource shuffling is suspended for the first 18 months. And CARB will review all the trades that occurred in that time period very carefully. There has been a lawsuit filed by the California Chamber of Commerce which basically says that cap and trade constitutes a tax that CARB is not approved to levy. The lawsuit happened on the eve of the first auction but did not disrupt it, and a CARB spokesman has said that it's confident that the program can withstand the legal challenges. So at this point in the presentation, I'm going to turn it over to my colleague, Peter.
Hello, my name is Peter Richardson. Thank you very much, Chris, for giving us some background to the new carbon dioxide legislation taking place in California. I'm going to talk to you a little bit about the market impacts. First and foremost, emission costs represent additional costs and risks to power plant operations, and in order to manage these risks, the power plant bids are going to have to be correlated to the cost of carbon prices. Bottom line, higher carbon costs are going to equal higher electricity prices. Additional legislation also means that there could be increased administrative fees. A little bit of background about what we're doing here at Genscape with the WECC region. We operate a SCUC model, that's Security Constrained Unit Commitment model, that we designed in-house. It has an algorithm that uses economic dispatch, and we have 22 individual regions for which we have supply and demand and price forecasts for. Our supply forecast consists of proprietary hydro generation, wind generation forecast, as well as proprietary unit level bids. In order to prepare our SCUC model for the new carbon legislation, we had to enhance our model in two main areas. Both of these enhancements revolve around what we call our carbon bid adder, which is essentially a $1 per megawatt cost. The first way we enhance our model is by applying an emission factor to every single unit within the state of California. So now our California unit bids are a function of both their heat rates as well as their emission factors. The second way we enhanced our model has to do with power that flows across the California boundary from the surrounding regions. We use a wheeling cost that is derived from our existing costs and also has a dynamic component that is correlated to the cost of carbon. So digging a little bit deeper into how we calculate the carbon adder, it has units of dollars per megawatt hour, and this is essentially equal to our emission factor, which is grams of CO2 per megawatt hour. We took the emission factor, our base case emission factors, from the public data provided by the California Air Resource Board. We convert the units from grams into tons, and then we multiply that by our carbon cost, which is presented in dollars per ton, metric tons of CO2. In the analysis I'm about to present, we use a base case coal price of $1.90 per MMBTU. These four charts that I'm presenting are essentially the same lines, or the same slope lines with different y-intercepts. In the upper left-hand corner, we're looking at a y-intercept of 0. This reflects no fuel cost for a generator's bid. And we're essentially looking at how the price of carbon impacts the cost associated with operating a power plant. The bottom three lines are your spread between efficient natural gas units and your peaking gas units, and the line at the top represents the added coal or carbon cost for a coal power plant. If we move to the chart in the upper right-hand corner, this is what dispatch looks with a $3 gas price. Essentially, you can see that the efficient natural gas units are pretty much competitive with coal power plants with a $0 carbon cost. And as carbon increases around the $20 to $25 carbon cost level, we start to see mid-merit natural gas units become competitive with coal. If we move to the bottom left-hand corner where we have gas price at $4, we can see that with the absence of a carbon cost, coal clearly is much more competitive than even the most efficient natural gas unit. But with a carbon cost of just $5 to $10, the efficient natural gas plants become competitive, and the mid-merits don't become competitive until, say, the $40 to $45 range. And then the last chart, we've got gas priced at $5 on the bottom right-hand. And even at the $50 price point, the mid-merit natural gas units don't become particularly competitive with the coal power plants. And at the $15 to $20 pricing point, we see the efficient natural gas power plants becoming fairly competitive with coal. Since the carbon adder impacts coal power plants more significantly than the natural gas counterparts, we dig a little bit deeper into what the coal power plants are that are serving the California market. The units highlighted in red here are the units that have long-term power purchase agreements with utilities inside of the state of California. You can see there's a fairly large discrepancy between the units that have long-term contracts and serve power to California than the units that do not. This data was also collected from the California Air Resource Board, and the emission fact and it's for the year 2009. If we just want to break that down so we can think about what that means in your day-to-day generation, Intermountain, which is delivering 11,800 or did deliver 11,877 gigawatt hours in the year 2009. If we break that down into an 8760 year, that's essentially comparable to delivering just below 1.4 gigawatts worth of base load power 24 hours a day. And if you compare that to, say, TransAlta, which does not have a long-term power purchasing agreement, those 275 gigawatt hours delivered throughout the years, only delivering approximately 31 megawatts of power 24 hours a day. Digging into the power purchase agreements with these coal power plants, Centralia, which does not have a long-term contract, is slated to stop burning coal by 2025. Unit 1 is supposed to stop in 2020 and Unit 2 by 2025. And these units will likely be replaced by gas units. Boardman has a long-term contract with San Diego Gas and Electric for 89 megawatts. This contract expires at the end of 2013, and Turlock Irrigation District also has a contract that doesn't expire until the end of 2018. Boardman is slated to stop burning coal by 2020. The Department of Water Resources has a contract for 235 megawatts with Reed Gardner that expires at the end of June 2013. Los Angeles Department of Water and Power had a long-term contract with Navajo for 477 megawatts that lasted until 2019. However, they will be divesting ownership by 2015. The Four Corners unit is a particularly interesting case. Southern California Edison sold off their 48% stake in units 4 and 5, and the Arizona Public Service is going to shut down units 1 through 3, likely in Q1 or early Q2 2013. The Intermountain Power Project has long-term power purchasing agreements with Los Angeles Department of Water and Power, as well as other municipalities, and these last through 2027. So in 2013 alone, we're looking at approximately 955 megawatts worth of coal base load generation being taken out of the bottom of our generation stack. So here we're going to present a little bit about our January valuation. I provided data from 2010 for a little bit of historical context. The analysis is limited since the implementation of the market redesign and technology upgrade, which only really gives us 3.5 years for comparison, and that's only 3 January contracts. A little bit of a, looking back at 2012, we've seen some significant new developments. Number one, each month set a new high heat rate for the contracts within California. This is to say the January SP contract was a new high heat rate, and that was the same for February, March, April, all the way to the end of the year. We saw a new high for our SP PV spread. It hit $12.80 in September. We saw a new high for our SP Mid-C spread, which hit $21.50 in both May and June. So now, as we look forward to 2013, it's sure to be another exciting year. And a couple highlights here. I think most people are probably aware we're having another fairly large beginning to our hydro situation in the Pacific Northwest. We just had a Pineapple Express at the beginning of December, which deposited a significant amount of precipitation, and quite a bit of that fell as rain as opposed to snow this year. We've got very high snow water equivalent at high elevations and fairly low at the low elevations. The rivers are at very high levels, and Grand Coulee is likely to begin January with a full reservoir. We also have more precipitation in the forecast, which means that Grand Coulee will definitely be full. A couple highlights here is as we look to January, if you look to our January power spread, you'll notice that we've got the SP Mid-C spread slated to hit $12. That's going to be a new record for a January contract. We've got our SP NP spread to reach $3. This is primarily due to the continued outage of the Songs unit. And due to cap and trade, we do not expect to see a higher frequency of SCE PCT congestion, but what we do expect to see is a higher magnitude of SCE PCT congestion when the congestion hits. So that'll be a new high for a January contract as well. And then lastly, when we look at the SP Powell spread, we're looking at approximately $11. It's fairly easy to say that the cap and trade is going to have a bullish impact on the California price hubs, but it becomes fairly challenging to know what's going to happen to the surrounding regions. It seems that the evidence leads to the fact that all of these contracts will be increased as they're correlated to the price in California. However, with our high our significant hydro situation, we're looking to have a full PDCI and PACI in the beginning of 2013, which is likely to mask a lot of the impact of cap and trade on the surrounding regions to California. So in conclusion, the main takeaways here are that cap and trade is going to create additional risks to power plant management. We expect to see increased heat rates inside and outside of California and increased spreads for California and the surrounding regions. I'd like to thank all of you guys for taking your time to listen to our webinar today, and would like to open up the floor to any questions that anyone has.
Thank you, Chris and Peter. Good job. We've got a lot of questions coming in, and just to answer a couple of the easy ones right off the bat, a lot of questions on will people be able to download or receive the slides. We'll make sure you get a link to download these slides after the presentation. Some people are asking if they can still ask questions. Feel free to send those in. And with that, the very first question, is will AB 32 make a difference in greenhouse gas emissions?
Well, I think it's probably too early to tell, but it's worth considering that California is the world's, I think, 9th largest economy and 10th or 12th largest emitter. CARB has a very, very strong influence in Washington and Detroit, and the overall key to success for probably the whole program is to inspire leadership at adjacent areas, and eventually, if it happens, the U.S. follows suit. And there were provisions in AB 32 to link with other future state, federal, or national programs.
Okay. Next question. The statement that FERC was unhappy with the resource shuffling provision implies that a FERC decision was rendered. Isn't there a difference between a FERC commissioner letter and an official FERC decision?
Yes, there is, and I apologize for the confusion there. I didn't mean to imply that a FERC decision was rendered, only that there's been many challenges from a lot of different points on what the definition of resource shuffling is, and FERC has made that clear. So I just sort of summed it up with a broad statement.
Okay, thank you. And next question, what's your take on the carbon price impact on SP/NP spreads?
So this is Peter. When we look at the spread between SP and NP, I don't think there's any real reason to expect that the cap and trade is going to change the order of dispatch between the units. However, we expect an increase in the spread simply because historically, when the higher heat rate units in Southern California were called out of merit order, we would see a price go up to cover their fuel costs. Now, in addition to the fuel costs, you're going to have to cover their emission costs, and it's likely that a higher heat rate unit will have a higher emission factor. So that's going to increase the spread when the congestion hits.
Okay, and just again, keep the questions coming. We'll be reading them out. Next one, can you repeat the comment on how carbon will impact congestion?
This is fairly similar to the previous question, but I just want to emphasize, I don't necessarily expect that the price of carbon is going to increase the frequency of SCE PCT congestion. What it is likely to do is increase the magnitude of the congestion when it hits.
Okay, thanks, Peter. There is evidence that electricity prices have already begun embedding in carbon prices in expectation of the market. Do you agree that this is the case?
Absolutely.
Yeah, I can add that when Peter and I first started running the model, the output of the model looked fairly similar to where the forward market was trading, give or take.
Okay, next question. Let's see. How will cap and trade avoid the problems of other cap and trade programs?
I'll take this one. I think unlike some of the other schemes like the European ETS that use projections, California actually used actual reported emissions to set the initial allocations. And additionally, offsetting, which was, I think, a fairly critical loophole in the ETS scheme, is a smaller part of this program, and it's more tightly regulated in the California Cap and Trade program. I think they learned from Europe's mistakes, basically.
Okay, thank you. Questions are coming in. Let me follow this. Do we have any idea what spot carbon price will generators use in their bids?
I think that's an excellent question. And what I did for my base case analysis is I used the market price that's trading right now. But I think that's a risky assumption, and that's a risky assumption for a number of reasons. Number one, the market's so new that there's not a lot of fundamental data available at this point to really use to create a valuation for the cost of carbon. And number two, when you look at the volumes of CO2 that's trading right now, they're fairly low compared to the amount of carbon that was sold off on the initial auction. So I mean, in the initial auction, they auctioned off 23 million tons of CO2 allowances, and when you look at what's trading, it's more along the lines of the hundreds of CO2 allowances. So I think it's going to be a little while before we can see reliable price discovery in the open market, which is going to create some uncertainty moving forward, especially in the near term. I think the best bet is to use a combination of the auction results as well as what the market sees. And for now, at least, we're using the market price to price in our emissions.
Thanks, Peter. Next question, what will the auction revenue be used for?
I think from what I understand, it can't be used to fix California's financial problems. Under California law, it has to be used for advanced energy resource or low carbon transportation or large energy efficiency infrastructure products, things like that.
Thank you. Thank you. Next question, if we have a year with normal weather, will there be enough allowances to go around to all of the generation units in the West?
It's becoming challenging to know what normal weather is at this point. I think the answer is yes. I think that's quite a complex question. So it's hard for me to give a very thorough answer right off the bat. However, there are a number of natural gas power plants that can provide power for reduced emissions. There's a significant amount of wind generation that can provide electricity with no emissions. And I know that this doesn't particularly pertain to a normal year, but at least this year it's looking like we'll have significant generation coming out of the significant hydro generation coming from the Pacific Northwest, which will be able to provide low emission electricity.
Okay, thanks, Peter. Next question. What does it mean that California is experiencing high heat rates this year? And the questioner says, if your answer could be in plain English, please.
Heat rate is essentially the price of electricity normalized for the price of natural gas. So what that means is when we see a high heat rate, that means we're dispatching less efficient natural gas power plants to cover the electricity demand for the region.
Thanks, Peter. Next question. How do you expect the monitoring of resource shuffling to impact electricity imports?
I don't think I'm going to be able to answer that question for a while.
All right. So just to the question, the person who asked the question will have to take that offline. Next question. During low hydro periods, do you forecast a list in the mid-C prices due to cap and trade? I can repeat the question if you'd like. During low hydro periods, do you forecast a list in mid-C prices due to cap and trade?
I'm assuming that by a list you mean a lift in the prices of mid-C. And I do expect that we will see an increase or a lift of prices in the mid-sea pricing region, since the price of mid-sea power is correlated to the price of California power.
Okay. Under low hydro periods.
Under low hydro periods, absolutely. And the other thing is BPA actually receives a lower emission factor than a lot of the surrounding balance authorities, simply because they've got a higher or they've got more renewable energy in their power portfolio. So this gives them an opportunity to sell power for a discounted rate relative to the other surrounding balancing authorities, which means that they're likely to take the pricing opportunity.
Thanks, Peter. Great questions. And next one, do you think that carbon costs are fully priced into forward California prices, or could there be more upside once the program goes live? And I can repeat that if you'd like.
I think that's another excellent question, and I do think that the price of carbon is priced into the future markets, and I don't think we'll see any, I don't think all of a sudden it's going to roll over into January 1st and we're going to see a dramatic change in our pricing regime. I think it's going to be slowly incorporated, and we'll see over time that the price will become more and more correlated to the price of carbon on the open market.
Thanks, Peter. Let's see. Please distinguish the impacts of C&T on electricity prices for residential versus industrial customers. Please distinguish the impacts of C&T on electricity prices for residential versus industrial customers.
Well, we model wholesale prices, so that really is our service, and our clients are all wholesale power producers. So we really look at it on a wholesale level from the point of view of our analysis.
Okay, thank you. How much of the carbon price do you expect to leak into out-of-state hubs? How much of the carbon price do you expect to leak into the out-of-state hubs?
I think that's going to be highly dependent upon what our generation resources look like for a given day or month or contract period. And the more low-emission generation we have coming from the surrounding balancing authorities, or the lower the overall cost due to low load, the less we're going to see the emission price leak into the surrounding balancing authorities. As we tend to hit summer, when we've got more peak California prices, and especially after we get beyond June and July, when our excess hydro generation from the Pacific Northwest begins to die down, I think that's when we'll begin to see a real uptick in the emissions pricing leaking into the surrounding balancing authorities.
Okay, thanks, Peter. We have a few more questions. Next one, does your model take into consideration the shutdown of once-through cooling facilities?
I could be wrong, but I think that doesn't start till 2015, and our service is really a Belmont next month service. So we're really looking at fairly myopic and just look out to about 60 days. So that's kind of beyond our immediate time horizon.
Okay, thanks, Chris. Next question: how will the difference in emission intensity? How will the difference in emission intensity factors assigned on BC compared to BPA imports impact mid-sea? And I can restate the question if you'd like.
You have to restate that, sure.
Okay. How will the difference in emission intensity factors assigned on BC compared to BPA imports impact mid-sea?
That's another excellent question, and imports coming from Canada are always an incredibly challenging piece of the market to forecast. I haven't read anything at this point regarding what the emission factor for power coming from Canada will be, so for the time being I'll have to assume that it'll be priced at the unspecified rate.
Which is what we assume.
Yep.
Okay, thanks, Peter. What impact will the hydro from BPA have on the prices given their own default emissions factor, parenthetically 1/5 of default? What impact will the hydro from BPA have on prices given their own default emission factor?
So I think I think what that question's talking about is the fact that BPA gets a lower emission factor than many of the surrounding balancing authorities, and I think it's going to have a very bearish impact on the California prices. I'm not sure that's going to carry through to mid-C to too high of a degree, specifically because packing and PDCI are pretty much full, meaning that most of the export capacity to California is maxed out. So it's not, California prices aren't being a significant price setter at this point.
Okay, good. We have two more questions. The auction results showed that there was a close match between the accepted bids and the California market auction and the number of credits sold. Does this imply that the market participants were primarily the state utilities and power generators going after credits they needed for their own generation, and that the other regulated entities, i.e. factories, did not participate?
That's an excellent question. What I can say to it is 97% of the entities that purchased emission allowances in the auction were compliance entities, and only approximately 30% were strictly financial. So I think what that says is that a lot of financial players at this point see a lot of uncertainty in this market and haven't been particularly interested in getting involved just yet. I'm not sure if that answers the question, but I hope it helps.
Okay. Thanks, Peter. Next question. Any thoughts on the secondary market? For example, is there anyone selling 1/10 of an ICE contract on a daily basis? Another example is, would the price trade be below the floor? So what are your thoughts on the secondary market?
So I haven't heard of any contracts that allow you to sell less than a full ton or a full credit. And I don't think that will ever become a standardized contract or have much purpose outside of very specific contracts. And I can't think of any purpose right now. On the open market, it's certainly possible for the price of a CO2 allowance to drop below the auction price floor.
Thanks, Peter. Next question. We have heard about California and Canada partnering on the carbon regime. What does that mean? We've heard about California and Canada partnering on the carbon regime. What does that mean?
Yeah, I have to go back to my last answer where we really look out 60 days.
Yeah.
We're really just putting those carbon prices into our model as it sits right now. So
okay.
I think I've heard that that's a possibility in the future, but it's not in our analysis at this point.
Okay, let me just interject with, we still see questions coming in. That's a good thing. And I'll ask a few more, and then, you know, if you don't get to ask a question or you think of one after the call, please don't hesitate to contact us here at Genscape. Next question. EPA has yet to be granted an official emission rate as an ACS. What do you predict it will be?
The literature I've read so far is an emission factor of 0.08 times the cost of carbon, and that's what we've been using as our default analysis. Obviously, a lot of the legislation around the cap and trade scheme is still in development, which makes a lot of this analysis difficult. However, I think something along those lines is likely to be the end result.
Thanks, Peter. What is the industry consensus on when songs will come back online?
That's $1 million question that I'm not going to pretend to know the answer, but what we can say is that it's unlikely that Unit 1 will be coming back online at all, and if Unit 2 does, it'll, or when Unit 2 does, it'll likely be at 70% of its initial capacity.
Okay, well, thank you to our presenters, Chris and Peter. At this stage, did you have closing comments? I think we're ready to wrap it up. And we thank all the participants. We will be getting out access instructions to download the presentation. We have a very broad and deep offering here at Genscape, so please don't hesitate to contact us directly with questions or a free trial on any of our services. And with that, we conclude today's presentation. Thank you.